Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. Well, if you're wondering what was the US CPI result, you can probably make out from the market reaction. No spectacular movements in currencies as the CPI came in line with market expectations. However, we did see some volatility in the bond prices. But focus will now turn to the ECB meeting, and what's interesting to note is the ECB's action in the face of very weak economic data. Germany, the manufacturing powerhouse in the EU, is really struggling, so it will be very interesting to watch. Good morning, JK. What's your take on yesterday's CPI numbers, and let us know for any developments on the ECB meeting front?
Good morning, Swaraj. So obviously the biggest news that the market was waiting for was the CPI from US that came higher than forecast on a month-on-month basis, was 0.3 versus 0.2 forecast. And of course, headline, that was the core. And on the headline, it matched 0.6%. And was, the favored Fed's measure, that is the CPI X shelter, which is not published actually, it was higher, and even the X rent also was higher at 0.366 versus 0.195. And what market did was actually to latch on to the good part of the report, that is the core year-on-year number, which came at 4.3% versus the 4.7%. And the Fed is looking at that rate coming below 4% to keep their policy on the steadier side, and perhaps look at meeting their target. So initially the treasuries were slammed higher with the 2-year, slammed lower actually, yields higher, and 2-year yield touched a high of 5.08%, and the 10-year went up to 4.35%. But later on, they actually dropped. 2-year dropped below 5% again, and 10-year ended the day with about just 1.1 BP higher, or there 1 BP higher. So there were lots of buyers on the dip in the price in yields, because I think the market has generally been expecting this kind of number, and more towards the expectation on the interest rates, like September. The rate hike prospects are almost zero. In other words, a pause is at a 98% probability. November hike probability has inched up to 48%. But now the market perception is that even though it's closer to 50% probability, and may still go to actual hike, but that may be the worst case scenario for the rates in the US. That is how the market is seeing. Therefore, there is no major selling pressure on the bonds right now. And in any case, selling of bonds has been taking place because of higher supply, and that seems to have slightly tapered down now. So that's the treasury action, which was kind of mixed after the report was published. Now on the currencies, we had more action on on the yuan, which has now slipped below 7.27. This is on the combined impact of so many actions taken by the central bank. The recent one being closer scrutiny of higher larger deals in the forex, and so it's like a micromanagement which they started to do and put the traders on alert. And it seems to be long liquidation by traders, as you can see that the offshore yuan is now stronger than the onshore yuan, at least as per yesterday's close. Therefore, you can actually see some more liquidation in the dollar long against the yuan. And of course, if we do get some data to support, on the positive side, we could well see some more gains for the yuan. But as of now, it doesn't look like a trend change. But as for other currencies, GBP was weaker at multi-month lows, because following the weak unemployment report the other day, We have also seen GDP coming at minus 0.5% versus minus 0.2% that was expected, and clearly showing that UK economy is started to feel impact of interest rates hike over the last 1 year. In fact, industrial production as well as the manufacturing production were all lower than expected, and so that actually led to GDP being sold off. Definitely, there is an expectation of another hike in UK, but probably market is starting to feel that even we are reaching a close to peak in UK rates as well. And immediate focus, of course, as you mentioned, is about the Eurozone. Rather the ECB decision on rates today, and that's almost like market discounting shows there will be a hike of 0.25%. That's the 10th consecutive hike that they would be doing, and of course, I mean, market is not really worried much about this also, because they possibly feel that looking at the economy, this hike may be the last one in the cycle, at least for now. Because we had more evidence of Eurozone economy weakening. Industrial production in Eurozone came quite weak yesterday, both on month and on year-on-year basis. Year-on-year basis, it turned negative from a positive number. And so I think ECB's forward guidance I would be more closely looked at, and of course there was some bullishness in the euro intraday, because the ECB forecast is probably going to be 3% inflation for the next year as well, and that is some higher than what they what their target for. And that, in other words, it is unchanged from the previous forecast. So that led to some euro buying, but I think overall euro looks like a limited upside. So even if we do see a hike by ECB, we'll see only a knee-jerk reaction upside, and I think it can very well be on the lower side. And as far as the stock market is concerned, not much of an action was seen. US markets were mostly on the sidelines, and very little movement was seen. But it was the Eurozone, rather the European markets that were down, and I think they were taking a cue from the industrial production data and continuous stream of weak numbers that we are witnessing from the Eurozone. As far as the rupee is concerned, as expected, we did not see much reaction to the India CPI coming lower, or the higher industrial production number. Neither did we see any significant move post the US CPI in the NDF market. In fact, rupee has been taking its cue mostly from the flows and also the RBI actions, and the flows have been mostly on the buying side, and RBI has been on the selling side whenever there is a attempt to break about 83.05. And so yesterday was also boxed in a narrow range. I think this could well continue for some time. In fact, we were not seeing much reaction even to the Chinese Yuan strengthening in yesterday's trading. So market remains hesitant to build long positions at or above 83 for fear of central banks in intervention, which is seen quite aggressive in the recent days. And as far as other drivers, stocks were firmer overall. FA flow was negative, but crude oil continues to be above 92 USD per barrel, which is fundamentally negative for the INR. And on the other side, there was some good news on the bond market in India with the central bank's decision to remove the cap on the amount of bonds held by the banks in their HTM portfolio, the hold to maturity portfolio, which removes the volatility in the PNL due to market volatility in the prices or the yields, and that supports the bond market. We could see more buying. In fact, yields have been capped at 7.25% despite the higher CPI number from India, and it's dropped to 7.17 now. And this could be good news for flows also, because the foreigners who have been much less exposed to Indian bonds could well be seen increasing their investments into Indian bonds in the coming months, because anyway the stocks are seen to be somewhat fairly valued, and with less exposure to Indian market, FIS flows can increase in the bond market. And this also coincides with somewhat peak in the US yields, which might be seen seen, particularly if Fed goes on another pause. So that's some good news for Indian markets. Otherwise, overall, see the rupee in a range between 80 to 80 and 83.10, narrowed down much more, and forward premiums have been slightly higher because of the half year in considerations, as well as the US yields being capped for the time being. 80 to 80 break can probably lead us to another 20 paisa drop. Thank you.
Thank you, JK. And just a quick summary, when it comes to US CPI core was higher on a MOM basis, but the headline was in line with previous month. Rate hike expectations for September is almost zero, while for November hike probability has inched up to 48%. When it comes to currencies, Chinese Yuan has slipped below 7.27. This is because of the combined action taken by the PBOC, scrutinizing large flows plus the long unwinding of traders, which is happening. GBP was on the weaker front at multi-month lows due to weak unemployment data and weak GDP data. So all of this combined, you can really observe that UK economy is feeling the impact of the rate hikes. The ECB rate decision is today, so market is showing that there will be a hike, but further hikes remain uncertain as weak data continues to stream out of the EU. So the key thing to look out for will be the forward guidance provided by the EU. For rupee, we didn't have any major movement. RBA action and flows is something rupee is taking direction from. Oil continues to be a negative for rupee, while we'll keep checking on the flows when it comes to the relaxation on the HTM bonds, the relaxation in the HTM bond regulations by RBI. So probably that can attract some flows, and we'll keep an eye out for that. That's it from us today. Thanks for listening, and tune in tomorrow for another round of fresh updates. Thank you so much.